Welcome to the video. Today we are tackling how to roll over expensive 457 and 401A plans to stop paying unnecessary fees. We will show you why these fees are corrosive, how to move your money via a direct rollover, and where to move it for lower cost investing. To smoothly start, we will outline our agenda and then proceed into a short disclaimer before we dive into the details. Here is our agenda. First, why fees matter. Next, which accounts can roll into which destinations. Then, we will go step by step through the direct rollover process. After that, we will cover common pitfalls and how to avoid them. We will also discuss whether to roll into an IRA or your current 401k math. We will look at fee math to quantify the impact. Finally, we will test your knowledge with quick quizzes. This video is for educational purposes only and is not financial, tax, or legal advice. Tax rules vary by jurisdiction and by individual circumstances. Plans also vary, so always read your specific plan documents and confirm with your plan administrator and receiving custodian. Consider consulting a fiduciary advisor or tax professional before acting. With that clarified, let us transition into the problem fees. High fees in legacy employer plans, often ranging from about 0.37% to 0.9%, drag down your returns every year. In contrast, low-cost index funds often charge under 0.07%. The spread between these costs might seem small, but over 20 to 30 years the difference compounds and can siphon tens of thousands of dollars from your retirement. The solution is to consolidate accounts and move assets to low-cost platforms to reduce fees. Now, let us move forward and discuss where these plans can roll. In most cases, a 401 plan can be rolled into a traditional IRA or a Roth IRA if you elect a conversion and accept the tax consequences. Governmental 457B plans can also typically be rolled into a traditional IRA or converted to a Roth IRA. Alternatively, some people consolidate into their current employer's 401k plan if it accepts incoming rollovers. Importantly, non-governmental 457B plans are generally not eligible for rollovers to IRAs. They are often restricted to other eligible 457 plans or distributions according to plan rules. Always confirm the type of your 457 plan and consult the summary plan description. With destinations clear, let us proceed to the direct rollover process. Begin by opening your destination account first, whether that is a traditional IRA at a low-cost brokerage or your current 401k if it accepts rollovers. Next, call the old plan administrator and specifically request a direct rollover, also known as a trustee-to-trustee transfer. Then, complete any required forms to authorize the transfer and verify the receiving institution's details, including the IRA or plan number. If the plan sends a check, ensure it is payable to the new custodian for the benefit of you and not to you personally, to avoid withholding and taxation. Finally, track the transfer until the funds are posted, then invest according to your low-cost strategy. With the steps laid out, let us visualize how parties interact during this process. This sequence diagram illustrates the interactions among you, the old plan, and the new brokerage. First, you open the new IRA at the low-cost brokerage. Then, you request a direct rollover from the old plan. The old plan verifies that you are eligible, often due to separation from service. The old plan initiates a trustee-to-trustee transfer, either electronically or by mailing a check payable to the new brokerage for the benefit of you. The new brokerage receives the funds, and you proceed to allocate into low-cost index funds. A note indicates that withholding would have occurred if the transaction had been an indirect rollover paid to you personally. With the process mapped, let us quantify the cost of fees with a clear example. This table shows the power of fee differences. We assume a starting balance of $100,000 and a gross market return of 7% annually. With a high fee plan at 0.9% expense ratio, the approximate value after 20 years is $327,000. With a low-cost expense ratio of 0.07%, the approximate value after 20 years is $382,000, a difference of roughly $55,000. Extending to 30 years, the high-fee plan grows to roughly $590,000, while the low-cost plan grows to approximately $747,000, a difference of around $157,000. These are approximations that illustrate the impact of fee drag. Now let us contrast direct and indirect rollovers. On the left, a direct rollover is a trustee-to-trustee transfer. There is no mandatory 20% withholding, and funds never touch your personal bank account, generally simplifying tax reporting. On the right, an indirect rollover involves a distribution paid to you, imposing a mandatory 20% federal withholding and a 60-day redeposit deadline. Missing the deadline may trigger income taxes and possible penalties. Consequently, the direct rollover is the safest and cleanest approach for most people. Next, we will present a short, interactive quiz to reinforce this. Question: to avoid immediate taxation and mandatory 20% federal withholding, which method should you use? Options are: A. Indirect rollover paid to you, then redeposit within 60 days. B. Direct rollover from old custodian to new brokerage or plan. C. Withdraw to your bank, then wire to the IRA within 30 days. D. Cash out and reinvest later. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The direct rollover from the old custodian to the new brokerage or plan. This trustee-to-trustee transfer avoids the mandatory 20% withholding and keeps your money fully invested. Now that we have confirmed the correct approach, let us move on to a second quick quiz. Question: which destination often gives you the broadest, lowest cost investment menu after leaving an employer? Options are: A. Leave assets in the old 457 or 401AB traditional IRA at a major low-cost brokerage. C. Money market in a taxable account. D. Cash under the mattress. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. A traditional IRA at a major low-cost brokerage. This option usually provides access to broad, low-fee index fund menus. Depending on your plan, rolling into your current employer's 401k can also be a strong option if its fees are low and it accepts rollovers. Now, to deepen understanding, let us add a concise, markdown-driven checklist you can save. Here is a markdown-style checklist to follow. First, open the destination account, either a traditional IRA or your current 401k if rollovers are accepted. Second, call the old plan and request a direct rollover only. Third, complete paperwork and verify the pay line is the receiving custodian for the benefit of you, not your personal name. Fourth, track the transfer, confirm receipt, and allocate into low-cost index funds. Fifth, document everything, including statements, confirmations, and notes from your plan and custodian. As we proceed, let us enrich the visual understanding with a mind map of your decision flow. This mind map organizes the key concepts. The central idea is the rollover strategy. Under Accounts, we list 401A, Governmental 457B, and note that non-governmental 457B typically cannot roll to IRAs. Under Destinations, we show Traditional IRA, Roth IRA via conversion, and the current 401k if it accepts rollovers. Under Method, we emphasize direct rollover, trustee-to-trustee, and the absence of 20% withholding. Under Pitfalls, we include indirect rollover, the 60-day rule, mandatory withholding, and checks payable directly to you. Under Action Items, we list opening the destination account, calling the old plan, submitting forms, tracking the transfer, and investing in low-cost index funds. Next, let us reinforce the key points. These are the main takeaways. First, the fee gap between many legacy plans and low-cost index funds can translate into tens or even hundreds of thousands of dollars lost over time. Second, after separation from service, rolling 401A and governmental 457B accounts into an IRA is a common and effective approach. Third, use a direct rollover to avoid mandatory withholding and 60-day redeposit risks. Fourth, consolidation simplifies your financial life and can lower costs. Fifth, always confirm your plan type and its rules, especially for non-governmental 457B plans, which often have strict limitations. To wrap up, let us summarize and give you a clear call to action. In summary, open your destination account at a low-cost brokerage or verify your current 401k accepts rollovers. Call the old plan and explicitly request a direct rollover. Complete all required forms, verify that any check is payable to the receiving custodian for the benefit of you, and track the transfer until posted. Invest in a diversified, low-cost allocation aligned with your time horizon and risk tolerance. Finally, keep thorough records and consult a professional for tax reporting as needed. Before we finish, let us quickly revisit the most critical pitfalls one last time. Avoid indirect rollovers, avoid checks payable to you, and avoid letting funds sit uninvested. Thank you for watching. If this video helped you reduce fees and improve your rollover strategy, please like the video, share it with someone who is stuck in a high-fee plan, and subscribe for more practical guides. In the comments, tell us your biggest fee discovery or your rollover success story. Until next time, keep your money working for you and not for unnecessary fees.